Behavioral Finance Notes, Episode 2. What exactly is investor sentiment? Opening. Welcome back to Behavioral Finance Notes. In the previous note, we discussed why irrational trading does not necessarily get arbitraged away. Today, we dive into one of the most discussed concepts, investor sentiment. The term appears everywhere in academic papers, financial commentary, and market discussions. But a natural question is, what exactly do we mean by sentiment? Why the concept is confusing? At the first glance, investor sentiment seems straightforward. It sounds like investor optimism or pessimism. However, when reading the literature more carefully, it becomes clear that different studies often use the term to describe different things. Sometimes sentiment refers to investor beliefs, sometimes it refers to trading behavior, and sometimes it refers to market outcomes such as persistent overvaluation. When the same word is used to describe multiple layers of the market, interpretation becomes more complicated. Three possible meanings. It is useful to separate at least three possible interpretations of investor sentiment. First, sentiment can refer to psychological expectations, how investors feel about future returns, independent of fundamentals. For instance, after a market rally, investors may become over-optimistic. Second, sentiment can refer to observable trading activity, for example, speculative buying pressure, like a surge in tech stocks during a boom, retail trading waves of flows into certain types of assets. Third, sentiment can refer to price level effects, situations in which securities become systematically overpriced, such as tech stocks during the dot-com bubble, or underpriced relative to traditional valuation measures. These three interpretations are related, yet importantly, they are not identical. If we don't distinguish them, it leads to confusion when interpreting empirical results. Why this distinction matters? This distinction matters because when a study claims a sentiment effect, what's really going on underneath may be completely different. The result could stem from biased expectations, trading frictions, institutional constraints, or limits to arbitrage. Without clarifying which layers is being measured, it becomes difficult to understand what exactly is driving the observed pattern. For researchers, conceptual clarity is not just a philosophical concern, it directly affects how we interpret empirical evidence. Research perspective. From a research perspective, thinking carefully about definitions is often the first step before engaging with empirical findings. Rather than asking only whether sentiment affects prices, it is equally important to ask which dimension of sentiment is being measured: beliefs, behavior, or equilibrium outcomes. Maintaining this distinction keeps us from simply taking results at face value without understanding the underlying mechanism. Closing. Investor sentiment remains one of the central concepts in behavioral finance, but its meaning depends heavily on how it is defined and measured.
In future notes, we will continue uncovering how behavioral forces shape asset prices within institutional structures.